With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then Channelchek truly is the orchard. The listed companies support Channelchek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for Channelchek so you're always up to date on what's going on at the small and microcap data place. Welcome to the C-Suite series presented by Channelchek and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on Channelchek. Today's interview features InPlay Oil, OTC ticker symbol IPOOF, TSX ticker symbol IPO. Noble Senior Research Analyst Michael Heim interviews InPlay Oil President and CEO Doug Bartole. Visit channelchek.com or click the link in the description for Noble's research on InPlay Oil, as well as news and advanced market data. And now, here's Michael and Doug.
Today we have Doug Bartole of InPlay, an exploration and production company, oil and gas in Western Canada. Doug, it's been about a year since we've done this interview before, so why don't you just get us up to speed with what's been going on the last year?
Yeah, it has. It's a pleasure to be talking to you again here, Michael. You know, it's been quite a year. In fact, it's been a remarkable year. We've been able to survive the demand destruction caused by the COVID pandemic. Crude, the commodity looks solid right now, and if you ask myself and many people, quite solid going into the future here as well. It all started with us getting a very favorable 4-year term loan in the fourth quarter of last year. That allowed us to get the capital program started again. It allowed us, we started bringing on our production, and the results of it are just astounding. We actually were able to get back to pre-COVID levels, our production levels of 2019 of over 5,000 BOEs a day. I think more astounding was the fact that we increased our reserves in all 3 categories by the end of 2020 over 19. That's a feat that again is quite remarkable, and very proud of our team that we accomplished that, because very few of our peers were able to grow their reserves without diluting their share count, and we were able to do that. So yeah, no, it's been a great year. I haven't been this excited about what's going on with our company in the future in a long time.
You mentioned you're back to drilling. You had 3 really successful wells in the Pembina Basin where you'd made a tuck-in acquisition. What excites you about that area? Why are those wells doing so well?
Yeah, that acquisition was a tremendous acquisition. A lot of work was put into that. It was a bid process. We knew the area would be solid. So far, it's just exceeded everything we expected. We drilled the first 3 wells. Those wells came on the end of March. The initial results are exceeding all of our forecasts. Because of that, we actually altered our drilling program going into the next round of drilling, where we've actually just spudded another 3-well pad directly offsetting these wells. That's 100% working interest property, the acquisition, and it's all within our control. We built a full modular battery in the first quarter as well that is now going to accommodate the full-scale development there. So that's 2 to 3 years of drilling that's going to occur, up to 25 wells. It's going to be adding a lot of value to InPlay for quite a while here. So, it's just it was a fabulous piece of business that we were able to accomplish at the end of last year.
And we're seeing the improvements on the cost numbers, both drilling and operating. I guess I've been a little surprised we haven't, with this level of oil prices, we haven't seen more drilling activity that might start to push up prices. What are you seeing around in your area in terms of drilling?
Well, I mean, Q1 wasn't too bad, other than some cold. There's a little bit of, just due to typically that's the most active quarter in Canada. Just so there was a bit of dilution of the crew, so a little bit of slower and things like that. But I think it all goes back to right now just the discipline of the producers right now. in capital spending. We all incurred more debt through 2020. The rig counts have dropped significantly, which we know, and they haven't been rising as fast as you may think. I think there's a piece involved in there with hedging, where the hedging losses are from hedges that were put in last year that are occurring. So those will have to start rolling off. But I think more importantly, we're sitting here and we're watching the market fundamentals, the supply demand fundamentals. And I think as the industry and the producers, it's been remarkable how disciplined everybody's been in regards to, okay, let's see where demand goes. Let's get it back to the pre-COVID levels. And then secondly, let's bring back the current curtailments that are occurring with OPEC plus, and what's going to happen with Iran. And I think people want to see those market fundamentals change, before they get too much more aggressive. And the third thing is, there is a lot of ESG pressure. We've seen it specifically in the States with Exxon and adding two activists groups to their board. You're seeing Shell getting sued in their home country. So there's a lot of activists and investors that are demanding these changes, which again are going to change the mentality towards growth. You heard the same coming from companies like EOG and Devon here after the first quarter. So things are changing, and again, I don't see the access to debt and to equity being as favorable as it was during the last big growth term. So there's a lot of factors in here that potentially mute the aggressive growth that we saw, from 2008 to give or take the highs in the U.S. of 13 million barrels in 2013. So, we will see it. We will see some cap or some increase in the cost structures. And the one thing is, though, we're still using lower pricing, and I think there's enough absorption in the increase in the commodity price to still have us with payouts that are strong, and rate of returns on drilling these wells that are still going to be strong, well under a year, and in some of these cases less than a half-year payouts on some of the drills we're doing.
I guess that begs the question. You mentioned some of the environmental issues other energy companies are facing. Is that something that you're facing at this point, or are you small enough that you kind of go below the radar?
Yeah, I mean, that's a great question. I mean, sure, we're small enough that we go below the radar, but that doesn't mean we're not thinking about it. We're not doing our part. I mean, we're continually looking at reducing our emissions, doing things differently. We barely flare any gas ever anymore, which is something that occurs much more significantly in the US and honestly, like in the Middle East in many cases. So, I mean, in Canada, we get a bit of a bad rap, and a lot of it is due to the oil sands and celebrities and other people, how they view things. But we have the most stringent environmental regulations in the world, and we have to oblige them. And even then, we are continually looking at ways to improve all of those things that we do. So that's something that won't change and will continue as we go forward.
So you talked about the added returns, and then you've taken on some debt. We're in a good position now with oil prices high and cash flow coming in. I'm just kind of curious how you think about how you want to use the cash going forward. Obviously, the drilling's going well. You took on a little additional debt. How do you weigh those two factors?
Yeah, and again, we'll be disciplined, as I mentioned. As you said, we increased debt in 2020. We want to get that down. We want to get our target levels back down to at least 1x debt to cash flow. And I mean, on our current forecast, which we have published, we do get there in the first half of 2022. But our forecast in the second half of the year is close to $5-6 WTI, less than current future pricing. I mean, we could see that actually occurring before the end of the year, getting down to 1x. So a little bit of extra capital spend, plus adding to the growth, and a little bit continued free funds flow going to pay debt. Again, we estimate somewhere north of 30 up to 35% of our funds flow being free to pay debt, and really get us back down to those 2019 pre-COVID debt levels. So yeah, that's part of the remarkable turnaround, how quickly that's occurred, and we can't be more pleased with it. We were able to, as us and many of the companies in the industry, we got more efficient again through COVID. We're our efficiencies have allowed us to get margins, operating income margins of north of 60%, which is going to be a record for us. Previously, we'd get in the mid 50% of those margins. So all of those things are adding up to just to where we stand today. The other piece is we'd like to be paying down the debt and get our debt lower, because we'd like to be able to add more acquisitions. And if we can have a low enough debt, we can add acquisitions on the balance sheet, and then again continue to pay them down accordingly, we will have minimal dilution of our share count going forward, which will benefit all of our shareholders.
Are there other acquisition possibilities that can be in acquisition? Tuck-in acquisition certainly has turned out to be a good one.
There are. I mean, we've been able to do one every few years, a really solid acquisition. I would be hard pressed to say we'd get an acquisition like we purchased last fall at the price we purchased it at today. Obviously, with the prices going up, we just haven't seen a lot in our area again right now, and of our type of assets. So most of these processes are bids. They're competitive. You have to go in there, take your best shot at what people are purchasing things for these days, and we'll see where they go. So would we like to do some? Yeah, for sure we would. We would like to get bigger. We'd like to get more relevant. We think that's important. I think size is a piece of the business that many people are looking for. And again, you get bigger, you get lots of free cash flow. It gives you lots of opportunities in the future to buy back shares, to pay dividends, all of those things. So that's our plan.
Everything's pretty rosy here. I've got to ask you about your production guidance. You hit in the first quarter, you almost hit your bottom level with those the success of those 3 wells, and we've got more wells being drilled. What would it take for you to adjust that number higher?
So we are. I mean, again, I'm so happy that the fact that we are now heading into record production quarters. We're going to start beating our highest production quarters ever. We're getting into record funds flow quarters. And these 3 wells, I mean, we've got a little over 60 days of production on them. We're going to have some more wells drilled and on production before we release our Q2 financials, which we expect in the morning or before markets on August 11th. So we should have some initial results from the 3 new wells. And I mean, for all intention purposes, I would expect that we'll be able to adjust, with those type of time frames, we'll be able to adjust our guidance, with those Q2 financial release. And I'm pretty confident that any of those adjustments will be on the positive scale. As I mentioned, it'd be a bit of a balance between maybe adding a little bit more capital and but still maintaining solid free funds flow of, again, somewhere between 30 to 35% of that funds flow to pay down debt. So it's a great spot to be. The discipline's there, paying down debt, getting to our target of 1x debt to cash flow. The growth is there. It's going to be top tier in our light oil peer group. So I'm tickled where things are right now.
Is there anything that concerns you? What's your biggest worry? You're right. It's production's great, costs are down, oil prices are good. What's something's got to be going wrong?
Honestly, this is one of the times when I can honestly say I don't feel a lot of things going wrong. We just have such a good handle on our operations right now. I'm such a strong believer in where the pricing is going as far as inflation. Oil's typically a hedge against inflation. The other pieces we talked about, which I think is going to keep the pricing high. This is one of the few times in my career that I feel so solid about where we sit as a company right now.
So Doug, everything's going great. We've got the production levels back to the pre-COVID levels. Oil prices are high. The cash flow is starting to come in, but your stock's still kind of trading at the point it was at before COVID hit. What is it really going to take to get the stock price to realize the gains that you've made the last year?
Yeah, that's a great question. I mean, of course, we've had some huge jump on the stock price from our lows. I think nothing goes straight up, but we've hit some new levels that seem to be solid here. I think we're getting ready to work ourselves to the next levels with some of the information we got coming out in the next little while. We're going to hit like I say, record production this year, anywhere north of $55 WTI. Currently, we're looking at somewhere around 25% higher funds flow than we've ever had before, including record production. And you know, we've traded as high as $2 before. So I mean, over time, we've had, you know, some of the multiples have compressed. We're starting to see that multiple compression change to a little bit of multiple expansion. And you know, I see us moving pretty soon into the next level and continuing to move towards where we, you know, some of the highs that we've ever previously traded at. So everything's going in the right direction. You know, these are great times, great numbers. You know, I look forward to it when we reach some of our previous highs, which I can see happening.
Thank you for joining us for this C-Suite interview presentation brought to you by Channelchek. Visit our YouTube channel for more interview content, as well as virtual roadshows and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and the 6,000 other small and microcap companies listed.